There's a fear that the Fed's going to raise rates again. Well, of course they are. They've talked about this.
They've basically said, we are going to raise rates if X happens, and X is happening.
All right, guys, mortgages and real estate, they are getting hit pretty hard with one of the biggest surges in interest rates in history. Mortgage rates 2 years ago, high 2% on a 30-year fix. My fiance got 2.625% about 2 years ago now.
Yeah.
And now
we're approaching 7 again.
Again, yeah, mortgage rates are back up again, 7. So here's what sparked this whole conversation. So I'm on Twitter. By the way, follow me on Twitter, at Paul Gabriel. This was U.S. existing home sales. This is going back to 2000. 37% drop. Now, we're not trying to put fear, uncertainty, and doubt here. We're not being fudsters here. It's about looking at the data and determining what this data means for the future. Now, guys, look at 2020. This is COVID. Makes sense. And then all of a sudden, it skyrocketed. Guys, it grew at a rate pretty much the same as 2008, 2009. And now, fallen 37%. And that makes sense. And the reason being, let's do the math here real quick. Mo, what's your mortgage on your house?
2.75%.
Okay,
2.75%. Over 30 years.
Yeah. I'm renovating a house right now, and my mortgage is, I'm excited that I got locked in at 4.25%. Mm-hmm. Like, that's big.
Pretty damn good.
Yeah, because it was only in July when I locked the mortgage rate in, and it's like, oh my gosh, like 4.2, like, you know, and it was different. So let's say you have a $300,000 mortgage, okay? Let's do the simple math. 2.5% means you're paying $7,500 a year in interest. At 7% now, you're paying $21,000 a year in interest. That's almost triple.
Yep.
And if you're the average person who's buying a I asked a friend of ours named Hesh. He owns Liberty Home Mortgage here in Cleveland. And I said, if somebody's buying a house for $300,000, has a $300,000 mortgage, how much they make a year? He goes $120 to $150. Like, okay. So $120 to $150. This is a $14,000 increase. If you're making $120,000 a year, after taxes, let's call it $85,000. You just lost $14,000 extra on that number. That's an extra almost 20% of your take home extra. So what does that mean? Well, it means one of two things. You either got to get a much more lower mortgage, which means you need more down payment.
Or you need less house.
And I think it's going to be a combination of both. Okay. Another little, go ahead, Mo.
Allegedly, I don't know. I'm just reading articles out there. We're seeing supposedly demand soften now, and there's more cash buyers out there because people don't want to get as much of a mortgage. But who knows? I mean, we hear these stories back and forth. I don't know what's true and what's not true. This is just pundits talking, you know?
Yeah, so just this morning, Mortgage Bankers Association said mortgage applications fell 13.3% in the latest week. All right, guys, it makes sense. I mean, this should not be shocking to anyone that when mortgages tripled, essentially, in interest costs, not tripled, but 2.5 times more in a matter of a short period of time, it's going to cause these issues. Now, one thing I do want everybody to remember, though, is, you know what else is up a lot? Incomes. Mm-hmm. And they're only going to get better as time goes on and as the inflationary pressures of this world start to push incomes higher. So with these high interest rates, it's there to fight inflation, right?
Yeah.
But inflation still already hit us hard.
Right.
Unless we're going to have deflation, we're not going to be able to make up for the inflation we already had. Right. So if costs are 10% higher, it's just a matter of time before your income goes up along with it. GDP per capita is up significantly in the last few years. Mm-hmm. Go ahead.
Oh, I'm just looking at the average contracts right now. As of the end of the week last week, 6.62% for your average 30-year fixed mortgage for houses in that range. So I read it's higher this morning. I read it's at like 6.87 now or something like that.
I agree. I did read this morning that it's getting close to 7% again.
And we also saw bonds jump up this morning because of data that came out yesterday or something.
You know, there's a fear that the Fed's going to raise rates again. Well, of course they are. They've talked about this.
They've basically said, we are going to raise rates if X happens, and X is happening.
So remember, guys, we hear good economic data, and we're like, yes, good economic data. The Fed doesn't hear that.
No.
The Fed hears inflation.
Yep.
When they hear lower unemployment rate, when they hear retail sales are going great, they are okay with a slowdown in the economy because that will help fight inflation. Mm-hmm. They want 2% inflation. I don't know if that's realistic or not for the foreseeable future. As we print more and more money, it's the devaluation of the dollar that is inflation. So unless we curb this printing of money, think about it this way. If all of a sudden we doubled the money supply, put double the amount of dollars out there in the economy, all of a sudden now everybody's income goes up, the cost of everything doubles in terms of actual nominal dollars. That's inflationary. That's what that does. You're putting more money into the economy chasing the same number of goods.
Right.
That causes inflation. That's absolutely it. Now, the positive, like I said, is GDP is going to grow like crazy. And you go back to 1990, GDP per capita was 28,000 a year, give or take, and now it's 78,000 a year, give or take. Okay, there's no such thing as a good thing in and of itself or a bad thing in and of itself.
Yeah, it's kind of a push-pull that goes this way, and it's going to match out in the middle.
Yeah.
Actually, it's going to probably match out to the better side for over a long period of time.
Right.
Yeah.
And, Mo and I were talking, guys, if you have a great house that you're happy in, that you got a great, my fiance, like I said, we're finishing this new house. I told her we're never getting rid of her house. We're going to rent it out till the mortgage is done in 28 years. Why? Because it's 2.625%. Her mortgage right now is like $1,850 with tax and insurance. Yeah. And the house can probably rent for $3,500 a month.
Yeah.
I'm like, Lisa, it's not making her break, but for her, it's a great investment for her. She can pass it on to her kids someday. All these things that I look at going, why would we ever get rid of this mortgage? It's super cheap dollars.
Yeah.
Super cheap.
Yeah. Something you're probably not going to see anytime in the near future again.
Well, going a step further. When do we buy it?
When did you buy it? 19?
Yeah. We bought it for $320,000 in 2019. Okay. I paid cash for it. And then she bought it back from me in 2021. The value had increased to like $400,000, which was insane. But we got a mortgage for $330,000 or something like that.
Wow.
So we got all of our money back out of it at 2.625%. Or something, whatever the numbers actually are. The bottom line is we have no equity in the house from a check being written. So it's literally free money every month that we're going to write. Wow. And if you're out there and you need to move, and you have a low mortgage rate, I would strongly encourage you to think about renting your home. I'm not telling you to become a landlord, but why get rid of, can you beat that 3.5%, 4% return on that property on the rate you're paying? Now, you might need the money to go put as a down payment for another house.
Right, that's a different story.
Look at our CEO, Tim. Tim didn't need the money. I kept trying to convince him, Tim, don't sell your home. Just keep it as a rental. And he says to this day, and his wife was like, listen, I don't want to deal with the rental. Ironically, she leases houses for us. It's wonderful, but he regrets it now. He goes, man, we could have probably gotten, his mortgage was something like $730 a month because he was on his original house. Right. And he told me he can get all day long $1,700-$1,800 a month for his house. Yeah. That house that he moved away from. He'd been getting $1,000 a month in free cash flow.
Yeah.
So again, mortgage rates as they go up will hurt. However, as incomes go up, it'll even out. When I look at the cost that it's costing me to renovate my home, why are you laughing, Mo?
It's a lot.
Every day is a shock.
Because I think it hits me more because I've done, I call it 1.5 renovations in the past 3 years, 4 years. And now I see what you're doing. And I'm like, oh my God, just 2-3 years ago, I paid this and you're paying this now.
Well, Mo bought the house that I originally built in 2008 or 9. I renovated before Mo bought my house from me. And the cost from that renovation, that was only 2 years ago, 3 years ago, the cost from that renovation is a night and day difference to today. I'm like, wait, what happened?
And then I look at my house that I bought in 2019 and completely I renovated every single thing in that house except for the kitchen.
Yeah.
And like, I look at that, I'm like, man, that was cheap.
You didn't renovate the bathrooms.
Yeah, the floors in the bathrooms.
Oh, you did?
Yeah.
I mean, listen, but again, as costs go higher, it's going to make your home more valuable. If your home is $300,000 and all of a sudden the builder down the street is now building your exact home for $500,000, I'm throwing out numbers. Are you telling me your home is $300,000 anymore? No. And why would it cost the builder $500,000 to build that? Because costs go up, labor costs go up, material costs goes up. Your house is no longer worth $300,000.
Right.
Because if somebody would sit there and say, well, wait, I can build it brand new for $500, but this person might give it to me for $450, and I have a slightly used house.
Right.
Okay. Your house is not worth $300,000 anymore.
Correct.
And this is important for the way we look at all things. The only time we get into these absolute, like, this is crazy, is when we see absolute complete extremes, like these company valuations, or, I said about home mortgage rates. I'm like, listen, this is not going to stay forever. It just can't. And if interest rates today went to 15%, what would I say? They can't stay forever.
Yeah.
It's impossible.
I mean, this morning I was joking. I was like, let's send interest rates to 20%. I was like, yeah, that's because I want the housing market to cool. It's not going to last there. It's not possible to last there.
And eventually, and the reason to set interest rates so high is to fight inflation.
Exactly.
And at some point, it'll cause deflation if you fight it enough.
Right.
Go to an extreme. If interest rates were 100% right now, who would borrow any money?
Nobody.
Nobody would borrow money. The economy would come to an absolute standstill. People would lose jobs. Incomes would fall, and that's deflationary. So somewhere between 0% and 100% is some sort of equilibrium, and it's probably closer to, 0%. Not probably, it is closer to 0%. But I like to go to extremes to show me where the middle could be somewhere. Mm-hmm. That's what's worked for me as a value investor. So when it comes to homes, if you own a home currently, stick it out. You'll probably do well in that home just with inflation. And you have a great mortgage. Don't fight it. If you're looking for a home, if it's your first home, you probably don't understand what 3% interest rates are.
And that's what our friend Hesh said too. He's like, people come in and pay 6 and 7% interest, and they're like, okay, cool, because they don't know what 3-4% was.
Yeah.
They weren't paying attention.
They weren't in the market for it.
Why would you pay attention?
And historically, interest rates should be around for a home mortgage, 6%, correct, give or take. So guys, thanks very much. If you like this, share it with somebody who might find value in this and might be fearful of the housing market interest rates. And also, if you like our software, we have a special running $7 for 7 days. Go to everythingmoney.com and check it out. And also subscribe to our channel. Thank you for your time.